Chapter 12, our final financial statement in this book, the statement of cash flows. We waited this long to do it for a reason, and you'll find that out today. The first objective talks about the sections of the cash flow statement, how useful it is, and how it's formatted. So that's going to be the first part we're going to focus on. Then when that's done, we're actually going to go ahead and help you understand how to prepare a cash flow statement. That's going to be the bulk of your work over the next week until we meet next week. I'm going to finish it next week. I'm not going to do objective 3 right now. I'll wait to the next week, make sure we're all set, and then we'll finish off the chapter. Okay. So learning objective 1, again, the cash flow statement is, I think, one of the more important financial statements. It is a bit more complex to understand, which is why they kind of save it for later. But it's extremely useful because, you can't do anything without cash. You can't do anything without cash. And again, this statement simply follows cash. It doesn't follow anything else. It follows when cash is coming in, when cash is going out. And that's sort of the interesting part about this particular statement. Okay. And we're going to use it for lots of different things, as you'll see in a moment. But let's get started with how cash flow is looked upon. You have to go all the way back to chapter 1 when we looked at the types of business activities way back in the day. I'm not sure if you still have memories of that. And you'll remember the 3 types of business activities that were talked about back then: operating activities, investing activities, and financing activities. So operating activities is going to be the first way cash flow is classified. Operating activities tend to revolve around the income statement items, specifically, like revenues and expenses. Because when you have revenues, your cash is coming in. When you sell goods and sell services, you're collecting cash from customers. And so that's going to be the main way businesses collect cash on a regular basis is from their customers. But then on the other side of the income statement, you have expenses, and you have to pay cash, right? You need cash to pay your expenses. You're not paying your employees without cash. They want cash. You're not paying your rent without cash, right? Your landlord wants cash. You're not paying any of your utilities without cash. They all want cash. So that is certainly cash flowing out, revenue flowing in. Many of your expenses show cash flowing out. Not all of them, as you'll see in objective 2, but most of them do. So you'll see a more detail on operating activities related to primarily the income statement. Investing activities are really about purchasing assets for the company to grow, okay? And so we're pretty much looking at long-term assets. A heavy amount of that is in property, plant, and equipment, because when the company puts up new buildings and stuff like that, that's an investing activity because they, of course, they're going to own that for the long term and they want to use that to grow the company. So we're talking about investing activities in those types of ways, as you'll see. Investing activities reflect more the asset side of the balance sheet. Financing activities are the last type of activities. Again, financing, where is the company getting its money to buy those assets? So we're basically going to be focusing on long-term liabilities, long-term debt, and stockholders' equity. Well, why? Because that's where businesses get money, right? The stockholders put cash in to the business in exchange for shares of common stock. We've known that for a while. That's a financing activity when that happens. Businesses borrow money from banks and bondholders for the long term to get cash. That's a financing activity. Of course, they also have to pay them back, which is also a financing activity. Again, the flow goes both in and out, as you'll see. All right, so let's take a little bit of a deep dive here. First look is at operating activities. Operating activities, again, mostly follow what's on the income statement. So cash coming in, really the big one is selling goods and services, because you are collecting cash from customers. It's a main way of cash flowing into the business, okay? However, the company might also have investments and other types of things. So they might receive interest, they might receive dividends. That is also cash flowing in. That is revenue based. When they receive interest, it's interest revenue. Okay. So again, these are more revenue based related stuff. That's how you have to think about it. Cash outflow from operating activities, things that are going to be expensed, whether it's originally or soon. So here, when you buy supplies, or you buy inventory rather, when you buy inventory, that starts as your asset, but as soon as it's sold, it becomes cost of goods sold. It's an expense. So that's cash flowing out of the company for that. When you pay your salaries and wages, you're paying in cash, of course. So that's cash flow out of the company. Paying, income taxes or other types of taxes that you owe the government, cash flowing out of the company. Paying interest to any lenders. Remember, interest on any loans becomes expense. It's interest expense. So it's a operating activity because it ends up as an expense. The interest alone ends up as an expense. So that's an outflow activity. And of course, all other expenses that you have that require cash to pay, right, is going to, so whether it's insurance expense or others, you're going to need cash to do that. So again, cash flow measures cash that is flowing in, cash that's flowing out. Okay. When you look at the financial statements, this particular cash flow statement, when cash is flowing in, they'll look like it's a positive number, but positive numbers simply mean cash is flowing in. When you have an outflow, it'll look like a negative number, but it's not really a negative number. It just means that cash is flowing out. Okay, so you can read these appropriately without getting confused. So positive numbers simply means cash flowing in. Negative numbers simply mean cash flowing out. Okay, that's how they read it. Here are the investing activities that are listed here, secondly on the cash flow statement. And again, this really revolves around the assets, long-term assets. So any changes in investments, any changes in property, plant, and equipment, and so forth would be an investing activity. All right. But just like anything else, investing activities, cash flows in and cash flows out. So how would cash flow in when it comes to an investing activity? Well, cash would be coming in if they sell any property, plant, and equipment. They would be receiving proceeds from the sale of that. And so because they've sold an asset and they're receiving cash from that asset, it's cash flow in to the company. They might also sell any of the investments they might have. They might have debt investments. They might have stock investments for the long term. Anytime they sell those and money comes in, that's cash flowing in from an investing activity, from an investment. And they may themselves be making loans to others. Those notes that they make, literally it's an investing activity because it's a loan. And so in this case here, when they collect those loans, so they collect, say, their notes receivable, that's also an inflow from an investing activity. Okay. So that's interesting. What you'll see most of the time for investing activities on the cash flow statement, and what you actually want to see is cash flowing out. Why? Because you want them to buy property, plant, equipment. You want the business to commit to expanding. And the only way they expand is to, put more stores up or whatnot, or modernize their current stores to make it easier to sell stuff. You want to see cash flowing out for investing activities. That's usually a very good sign for a company that's committed to growing. So purchasing property, plant, and equipment is a really good thing. In this is one of the things I look for myself when I'm reading a cash flow statement. Are they investing in their future growth? And a lot of that is going to be here in purchasing property, plant, and equipment. They can also make investments when they purchase stock or bonds in other companies. Technically, that's an investment. It will be a long-term investment. So it's an investing activity. Also, when they actually make loans to other businesses, a lot of businesses do notes, right? So they'll have notes receivable, or they they'll pay money out, expect to collect it later. That's also cash flow flowing out. It's an investment because those receivables would be long term in many cases. All right, and the last activity that we're looking at is financing activity. Again, where they're getting their money. So we're going to be looking to the other side of the balance sheet, specifically the liability and equity side of the balance sheet. So these are activities would be considered financing activities that are cash coming into the company. So every time they sell shares of common stock, right, cash is flowing in from the investors, right? So that's an inflow. Every time they issue debt, bonds or other things, that's cash flowing in because they're getting money from issuing the bonds. So that would be a cash flow from investing activity because it affects, again, bonds payable, long-term liability, common stock is a stockholders' equity account. So it's going to affect the financing activities, is how we look at it. In terms of cash outflow, of course, those loans have to be paid back. So every time when they borrow the money and money is coming in, it's an inflow. When they pay it back, it's an outflow. That's important. They also have to pay, many companies pay dividends to stockholders because that affects stockholders, right? It's a cash flow outflow for stockholders' equity. So that's also an activity. Every time they pay dividends, it's going to be a financing activity as well. There are a lot of things businesses do, believe it or not, that don't involve cash, that affect the balance sheet specifically. Some examples of what we call significant non-cash activities would be buying, say, a building, but not paying cash for it, instead buying it with common stock. So they'll issue stock, they'll use stock to buy the asset. Okay, so when they do that, there's no cash involved. It's shares of stock for the asset. And so that would be a significant development because they just added, say, a building, which is going to be, it's a long term, that's probably plant equipment. However, they didn't use cash to buy it. So it's a non-cash activity. You probably remember back in chapter 10, we talked about certain bonds might have a conversion feature. They can convert those bonds to common stock. That is also a non-cash activity. So when bondholders decide to convert their bond to common stock, it's a non-cash payment. Their bond, they no longer have the bond. The bond has been paid with shares of common stock. That's it. So that's a non-cash activity as well. They might also issue bonds to purchase assets. So not only do you purchase assets by issuing stock, you can purchase assets by issuing bonds as well. And so that is also considered a non-cash activity. And then, of course, you might remember way back in chapter 9, when they might exchange one asset for another. In cases there's no cash involved there, it's a non-cash activity. So although these are significant because they do change the balance sheet in a big way, they don't involve cash, so they wouldn't be a cash flow activity. However, companies need to report these activities nonetheless. Many of them put it on the bottom of the cash flow statement as a separate schedule, telling the owners these are some of our big non-cash activities that we did this year. Others will put it in the notes to financial statements. But either way, these are things that happen but they don't affect cash flow. All right, so this is a story that's in your book, looking at the difference between net income, which is profit, right, and the cash that's provided by operating activities. Now, operating activities, I was saying earlier, really stem from that income statement. So you would think, oh, if they had $1 million in profit, they must have $1 million in cash flow. No. There's differences that you're going to learn about in the next part of the chapter here. There are some big differences. So here we have Kohl's. Here we have Kohl's Corporation. I don't know what year this is. They have $889 million in profit. However, they have $1.8 billion in cash that's provided from their operating activities. Okay, so there are going to be some differences into that. Look at Walmart. Walmart had a profit of over $16 billion. That was their profit. However, they had cash flow from their operating activities of over $25 billion. So you're going to see the differences in this in Learning Objective 2, but it is interesting. The statement of cash flow has a very specific format, okay? There's an order to how things work in all financial statements. Cash flow statements no different. The first thing that's always listed is the operating activities of the business. We are going to be learning the indirect method in Learning Objective 2, okay? How to prepare a cash flow statement using the indirect method. And so the operating activities are the very, very first thing that you're going to see on a statement of cash flows. The second part of the statement of cash flows will show the investing activities of the company. And then the third part of the statement would show all the financing activities of the company. Now, again, at the end of each of these activities, two things are going to be told. Either we're going to have cash that's been provided by these activities. And so, in other words, if the activity provides cash for the business, it's going to look like a positive number. However, there's going to be other activities that use, or we'll say they used up, and that's going to look like a negative number because it's going to be in parentheses. But all they mean is cash in or cash going out. That's it. That's all those. There's no positive and negative. It's just cash coming in, cash going out. Okay. So that's, again, I just wanted to reiterate that before we look at the statement. This is what the statement would look like. This is the basic format of a statement. The company name is always listed first, statement of cash flows, the name of the statement is listed second. And the cash flow statement actually covers a period of time, but it just covers the period of time regarding cash. So it's not subject to the periodicity assumption like we saw way back when in chapter 4 with the income statement. So here's the first section of the first part rather of the statement of cash flow from operating activities. There'll be a list of all the items here showing cash being used or cash being provided. So there's, again, if it's provided, that's coming in. If it's used, it's going out. Okay. The total for operating activities will be the first number listed in the far right column. Normally, this is a positive number, okay, normally speaking, because in most cases, businesses have lots of cash coming in from their operating activities, okay? So normally speaking, that's usually the first thing that you'll notice. Most operating activity is providing cash to the business. The second thing that you'll notice, as we mentioned, are all those investing activities, and there'll be a list of all the investing activities. Again, if the investing activity has cash coming in, that'll be a positive number. If it's cash going out of the company, it'll be a negative number, but it's just, again, whether it's coming in or going out. what you want to see with investing activities, because you do want to see a business that's committed to growing, you will often see this number is negative. And that's a good thing, because for the most part, we want to see companies investing in the future. And so that's just something to look forward to. In that case, that would be cash used, net cash used. It wouldn't be provided. If it was negative, it would be used. Okay. And the third part, as we looked at here, is the cash flow from financing activities. There'd be a list of all of that. Again, financing activities are from the liability and stockholders' equity side. If it brought cash into the company, you would see that. If there was cash flowing out of the company, you would see that. Finance activities can go either way, can be positive or negative. In other words, there can be cash provided or cash used. It sort of depends on what happens here. And so that number, again, can go either way in most cases. When you add all these three numbers together, that gives you the total either increase or decrease in cash, okay? Because all this statement does is follow cash. That's it, follow cash flow. And so that was, again, whether cash increased or decreased will depend on the sum of, or the product of all of these numbers put together, okay? And so that's that. So you have cash, you have a cash balance at the beginning of the period. You either add the increase or subtract the decrease, and the difference is your cash at the end of the period. This cash at the end of the period you will see on your balance sheet, and that's no BS. Even though I did put BS there, but I'm telling you, it's not BS. You gotta trust me on that one. And that's where you'll see the link between the balance sheet and the cash flow statement. The balance in cash at the end of the period will be on the balance sheet as the balance of cash on the balance sheet. And so you'll see those two linked, and that's it, pretty much. Then again, remember that note that I was telling you about on those non-cash activities. They will be listed here, and a total will be given here. But it's normally listed as a note. If it's not, it'll be listed at the very end of the financials of the cash flow statement, and it has actually no effect on the amount of cash whatsoever that the statement shows. So that's what's going on here for your introduction to the cash flow statement. Very exciting stuff, I'm sure. You're going to be looking at a series of transactions, and you have to classify them by type. In other words, operating, investing, or financing activity. So again, look for the hints. This is issued shares of stock. So again, when you issue shares of stock, that's stockholders' equity. Stockholders' equity is going to be a financing. If it affects the stockholders' equity account, it's going to be a financing activity. Okay, so that's your key. Know what part of the balance sheet. In this case, we're in stockholders' equity. It's going to be financing. Here we borrow $200,000 in a 5-year note. That's a long-term debt. Long-term debt is also part of financing activities. So that's a financing activity. The third thing here is we purchased 2 semi-trailer trucks. So when we purchase some really big ass trucks, that's investing in our assets, property, plant, and equipment. Property, plant, and equipment would be part of our investing activities. So that would be an investing activity. The fourth thing here is we paid salaries and wages. Salaries and wages will end up being an expense. Expenses are on the income statement, which is correlated with operating activities. And the last thing is we collected cash from services provided. Providing services is revenue. Revenue is on the income statement, which goes with operating activities. How are you feeling about this so far? Make sense? Is it flowing all right? It's better with an animal in front of you. I think it is much better with an animal. Okay, so we're going to go on to number 2. Sounds good? All right, back to the show. All right, here's the fun stuff. This is what's going to take up much of your time, is preparing the cash flow statement. It's not terrible. It's just tricky in the operating activity part. It's tricky. But once you get a hold of that, it'll fall into place like anything else. Remember the first time you put an income statement together or a balance sheet together, like classified balance sheet. Took you a little while to figure it out, but you did. And now it's like nothing. Same thing here. Okay. So to prepare a statement of cash flow, you need actually, we're going to use the indirect method. We need lots of information. First, we're going to need balance sheets that are from this year and last year. So we call it comparative balance sheets. Okay. We also need a current income statement. And then there's going to be additional information that we're going to need to understand that's going to affect the cash flow statement one way or the other, either because cash was used or there was a non-cash activity that happened. Step one, okay. I keep thinking of Dialupa here. Step one. I'll pick up the phone. He's only calling because he's drunk and alone. And I just, step two, right? Don't let him in. Okay, sorry, I digress. But 3 steps here. We have, we're going to need to determine net cash provided by operating activities. This is the critical step here, because when we actually did the income statement, we used GAAP, right? We used generally accepted accounting principles. And that meant we used an accrual basis to do our income statement. Well, to do a cash flow statement, we have to look at the income statement from a cash basis. And that's really what's going to take you most of the, if you have any struggles whatsoever in this chapter, this is where it's going to be. This is what's going to take your time. It can be done, no problem. But this is where much of your time is going to be done. Step one. Okay. So the step involves analyzing not only the income statement for the year, but also all the other data from the balance sheets and all. So that's going to take most of our time. The second step is to look in changes in any asset and liability accounts to see if there were any investing and financing activities that happened, or if there was any non-cash transactions. And for that, we need to look at the balance sheets, the comparative balance sheets, what changed from last period to this period. And step 3 here, we are looking basically at the end of all of that, we're going to compare the any change in cash from year 1 to year 2. We should be able to identify in the cash flow statement what the difference is. Okay. And that's something that you're going to get too out of this. Lots of interesting things. We use the indirect method for a number of reasons. Probably the most important to everyone is it's easier. Companies, it's also less costly to prepare. Another thing as to why we spend so much time on that step 1 that I was talking about is because the indirect method really looks at the differences between the net income, which is calculated on the income statement using the accrual method, and the net cash flow from operating activities, which is, of course, deconstructing that into the cash basis. And that's where the differences are going to come. So here's some of the things you need to do it. And this is all basically in your book as well. And this is something you're going to have to sit down and review before you actually sit down and try to do this. You should have all these statements in front of you when you do your homework. The first is the income statement. So this is the most recent income statement for computer services ending December 31st, showing, again, sales revenue, your cost of goods sold, all your expenses. And there's a loss. Again, they reported a loss on plant assets here because, again, any gain or losses, remember that other section, is going to be reported on the income statement. Okay, this is not a multi-step income statement. This is a single-step income statement in essence. So we have to note that this is part of the other income or other expenses that they've had here. Okay. Interest expenses here, income tax expense, net income. So this was their profit on that. So we need the income statement first. Then we need comparative balance sheets. Okay. Now a comparative balance sheet is just that. Compare the prior year with the current year and note the changes. Okay, so this takes a little bit of time. Every single account is looked at. So for cash, we went from 33,000 to 55,000. That's $22,000 more. So that's $22,000 increase. For accounts receivable, we went from 30,000 to 20,000. That's $10,000 decrease. Again, we're going from 2016 to 2017 when we are noting the changes, not the other way around. Okay. So for inventory, we went from $10,000 of inventory to $15,000. That's $5,000 more. It's $5,000 increase. Prepaid from $1,000 to $5,000. That's $4,000 more. So all of these have to be noted. Like land increased by 100, and that's a pretty large increase there, right? Buildings increased by 100. That's a very large increase there as well. Now this is interesting. The accumulated depreciation on the buildings went from 5,000 to 11,000. That's actually a $6,000 increase. It looks like a negative number, but again, we're just looking at the difference. Equipment went from 10 to 27. That's a $17,000 increase. And accumulated depreciation on that equipment increased by 2,000. So we have to note all the differences, and we've only done assets. The next page will show you liabilities and stockholders' equity, of course, not in the same format, which is always wonderful. So again, we're going from 2016, noting the changes to 2017. So for accounts payable, we went from 12,000 to 28,000. That was a $16,000 increase. We have more accounts payable. For income tax payable, it went from 8,000 to 2,000. That's $2,000 less, $2,000 decrease. Bonds payable went from 20 to 130. That's 110,000 more. It's an increase. Common stock went from 50 to 70, 20,000 increase. Retained earnings 48 to 164. That's a very large $116,000 increase. So we need to know all of these, and this information is all very important to doing our cash flow statement. That's 1 and 2, the income statement, comparative balance sheets. The third piece of information we need is what we call additional information. Okay. So it's important to note all of these because they're going to be factored in on how we calculate cash for cash flow. First thing you notice is depreciation expense was $6,000 for the building, $3,000 for equipment. So note that. Second thing you need to know is the company sold equipment with the book value of $7,000, which was, it cost $8,000, but then you had $1,000 of accumulated depreciation, so the book value was $7,000. But they sold it for $4,000, right? That's a $3,000 loss. The third thing is they issued $110,000 in bonds for land. So I see this is a non-cash, right? They issued bonds to buy land. That's a non-cash transaction. That's good to know. The fourth thing here, we have a building costing $120,000 was purchased for cash. So we used a lot of cash for that. Equipment costing $25,000 was also purchased for cash. We used a lot of cash for that. Common stock, we issued common stock, which means we raised cash, $20,000 in cash from common stock. The company paid a dividend, $29,000. It's a cash dividend, so we need to know that as well. Okay, so now we focus in on those operating activities. Why? Because we have to convert our net income from the accrual basis that we use to calculate it on the income statement to the cash basis that we need to use on the cash flow statement. So how do we do that? Well, this is where it is. First thing we need to do is we start with the net income. We start with the net income. We add back any expenses that we didn't use cash for. Depreciation is the biggest expense we have that we don't cut a check to anybody, right? Remember from chapter 9, we buy a car, we buy a building, right? We buy other things. We pay for it at that time, right? We can depreciate it over time as an expense, but that expense literally doesn't take any cash. We're not cutting a check for depreciation each year. We're simply entitled to depreciating that asset that we bought earlier. And so we add that in because it's a non-cash expense. So we add it back to net income. We deduct any gains and we add any losses. So remember, to get net income, we had to add other gains and we had to subtract other losses. We reverse that, basically. What this is saying is reverse those gains and losses. Okay, that's a very important thing. And then the thing that's going to take you most of your time is analyzing the changes to current assets and current liabilities that are not cash. So there's a lot of them. There's a lot of them. Okay. So for example, what changes do you notice? Well, let's do one at a time. First step starts with net income. Add back any depreciation. That's step one. Okay. Second step, if we took a loss, we have to add it back. If we took a gain, we're going to deduct it out. So in this case, we took a loss, we add it back. Okay, we reverse it because we're converting. Okay, we're converting to the cash basis. That loss was a paper loss, wasn't a cash loss. Now comes the hard part. All those current assets and current liabilities are looked upon very interestingly with a cash flow statement. So look at this. We have an accounts receivable balance. Now remember, an accounts receivable is you're waiting for cash, right? So when the balance actually goes down, the assumption is you've gotten more cash. That's a cash inflow. So that is very important to sort of understand, okay? So the company, for the cash flow statement, we add back any differences in the receivables, except in this case, the decrease in accounts receivable means we have more cash coming in. If you were expecting 30,000 and now you're only expecting 20,000, that was $10,000 more that came in. So for a cash basis, we have to include that 10,000 as cash coming in. That's why a decrease in accounts receivable is the same as more cash coming in. Okay. This takes a little bit of time. Inventory. Think about inventory. Inventory costs money. You got to pay cash for inventory. Right? So if your inventory balance went from 10,000 to 15,000, right? We are assuming that you have to use more cash for that. So any increase in inventory means less cash, means you have to use cash. So any increase in an asset account means you have to use cash. So an increase in inventory is looked upon as a use of cash. Remember, there's no positive and negative. It's just coming in or going out, or the appearance of coming in or going out. So more inventory means less cash. Less receivables means more cash came in from period X to period Y. We're comparing. Okay. So here we also have prepaid expenses. Remember, prepaid expenses, we buy, say, insurance, we buy supplies. They're assets, but as soon as we use them, we expense them. So in essence, basically speaking, if you paid cash for expenses, um, you need to deduct the increase. Okay. And so what happens here is the increase in a prepaid expense, like more supplies or more insurance, meant that you had to use cash to do it, so less cash. That's again just comparing the two periods. Okay, so this is how a cash flow. So they look at it. Well, the other side of the balance sheet are your current liabilities, which also, of course, require cash to pay those right away. So let's see what happens here. What happens when your accounts payable goes up? Well, accounts payable goes up when you have more accounts payable to pay, which means that you didn't pay it, which means you kept the cash. So anytime an accounts payable goes up, you actually saved cash in the business. So we add it back. I know it's one of those interesting things. So more accounts payable means that we saved cash. We didn't pay those bills right now. So we actually saved that cash. It's the same as $16,000 of cash staying in. That's how they see it. Okay. But we also had a decrease in the income tax payable. So in other words, we owed income taxes and we paid them down. That's how they decreased. If you paid that down, you had to use cash to do it. So it was a use of cash. So look how it ends. Net cash provided by operating activities. And I think that's the last slide on this. Yes. So look at the difference here. This was the profit of the company, 145,000. However, this is the net cash that was provided by operating activities. As you see, it's larger than the net income. Why? Because they went through all of these adjustments, right? Did it take cash? No. Did it save cash? Yes. Depreciation expenses in cash, that's cash staying in. This loss was a paper loss, not real cash loss, that's staying in. Okay, you collected more in receivable, that means you have more cash coming in. You spent more in inventory, that means you have more cash going out. You had more supplies or prepaid insurance, that means you had cash going out. You have higher accounts payable, that means you didn't pay your bill today, that means you have cash staying in. And you paid down the income taxes payable, that means you had cash going out. That's how, this is the most difficult part of the cash flow statement is organizing the first step, the operating activities. Because you have to sort of sit there and ask yourself, okay, did this mean that cash stayed in? Cash went out. Right. That's basically what the cash basis does. Follows the cash. So that is going to be, this step one is going to be your major work in this. This is a very nice summary, very nice chart that you want to have with you. Again, if anything goes on, if there's any depreciation or amortization expense or depletion expense added in, this is how to convert your net income from the accrual basis, which is what we use to do the income statement, to the cash basis, which is what we use to do the cash flow statement. Any gains or losses need to be reversed. So if you had a loss, add it back in. If you had a gain, take it out. And any changes in your current assets and liabilities, increasing of a current asset, take it out. Decrease of a current asset, add it in. Increase a liability, current liability, add it in. Decrease, take it out. If you do all of that, you will have successfully converted your net cash from operating activity rather, from the income statement to cash flow statement. Good chart to have. Okay, we've done a lot of frauds. So the first activity here, do it activity, focuses on the net cash provided by operating activity simply because it's such a big thing to do. It's going to take up most of your time. The rest of the stuff is not that bad. But this here takes a little bit of thinking because it's new. You got to start. I've been teaching you for the last 2 semesters on the accrual basis, which is how corporations do this, except when we do the cash flow statement. We do the cash basis. So you're learning something new here. So just remember that. Josh's Photo Plus reported a net income of $73,000. Okay, that's good. Included were depreciation expense of $7,000 and a gain of $2,500. Josh's comparative balance sheets show differences in receivables and payables from 2016 to 2017. You have to note those differences. What is the net cash provided by operating activities? Okay, so again, you're going to start with your net income, add back your depreciation. If it's a gain, take it out, right? And note these differences based on the chart earlier. So again, net income is listed first. Add back in the depreciation. It was a gain, so we added it on the income statement. We have to subtract it on the cash flow. The accounts receivable went up, okay, which means we had a $4,000 in cash that we are waiting for that didn't come in. We paid down our accounts receivable, which means we used $3,800 worth of cash. Adding all of these up will give you those changes, $3,300 change. So when you convert, this particular company is going to have $69,700 of cash provided by operating activities. Okay, so this part of objective 2, something you're going to spend some time on. The next steps are, I think you're going to find them much more straightforward because they are. All right. So investing activities and financing activities, right? Again, cash either comes in or out unless it's non-cash. So here the company purchased land by issuing bonds. This is a non-cash activity. They got more land for bonds, no cash. So this will be on the notes or a separate schedule that tells the owners that's why you have more land and more bonds payable. Okay. But what you can tell you is what they used cash for. For investing, remember they bought a building for $120,000. That was in the notes. Those are that additional information. So that means if they used cash to buy a building, that's cash going out. That's why it's in parentheses. They also purchased equipment, you might remember. That was from the additional information. They bought a building for $120,000. They also bought equipment, as you remember, for $25,000 in cash. And so again, that is going to show as cash going out. That's why it's a negative number there. Again, they bought cash here. So the first thing they did is they bought equipment for $25,000 in cash. The second thing that happened here with equipment is they sold $4,000 worth of equipment that cost $8,000. Right? So that's where they got that $3,000 loss. That was in the notes as well. And we saw that because we added it back in. The loss on the disposal of asset is added to the operating activity, whereas the sale, the purchase of the equipment and the sale of the equipment, which is cash coming in, is showed up on the investing activities. So operating activities will have the loss reversed. Investing activities will show that we bought the equipment for $25,000, so that was going out. We sold equipment for $4,000, so that was coming in. So net cash for investing activities means net cash was used, which is, again, to me, that's a good thing. We want to see companies invest in these types of assets. Very important. Okay. Next thing you might realize is that they, remember, they sold common stock and they raised cash, $20,000, right? So when they issued common stock, they got $20,000 in for that. So $20,000 from a financing activity because that came from common stock. That's a positive number only because it's cash coming into the company. They paid cash dividends. Again, that's the stockholders. So it's a financing activity. That cash dividend is a finance activity, but it's money going out, cash going out. Those are the only two financing activities they have. So they ended up using $9,000 more of cash for that. Okay. So now it comes to step 3. Now that we know the differences in what operating activities provided us, how much we used for investing activities, and how much we used for financing activities, we can add those numbers up, and now we can compare our cash. What happened to cash? Well, on the balance sheet in 2017, $55,000 in cash from $33,000. So we should see a $22,000 increase from 2016 to 2017, and the balance of cash should be 55. So let's check it out. Oh shit, gotta go back, sorry. Let's check it out. So what we had is a net increase in cash of $22,000. That's exactly what we were looking for. The difference between 2016's cash and 2017's cash is $22,000. Now we know why it's $22,000. It's $172,000 minus $141,000 minus $9,000. The difference, $22,000. We had cash at the beginning of the period of 33. We now have 22,000 more in cash. So our ending cash is 55. Okay. And it doesn't look like they did anything. I'm not going to do learning objective 3 with you yet. It doesn't look like they have do an exercise for that afterwards. But I think the last two parts were probably a little bit easier. Step 2, step 3. The real trick really is focusing on understanding step 1, which is, again, you're converting the net income, which was done on an accrual basis, to a cash basis. And that just takes a little bit of practice. As you see, it's a little bit, kind of throws you for a loop based on what we were learning, but you get used to it. It makes sense. Questions?